This is to overview Chapter 2, Consolidation of Financial Information. So, first we're going to discuss the motives for business combination. So a business combination could potentially be a parent subsidiary. Under FASB, ASC, business combination topic 805, and consolidation topic 810, they provide guidance to the acquisition method. The acquisition method embraces the fair value measurement for measuring and assessing business activity. Why would you even want to have a business combination? There's vertical integration, there's cost savings, quick entry into new markets, economies of scale, more attractive financing opportunities, diversification of business risk, or potentially business expansion, and increasingly competitive environments. So sometimes businesses will combine for any of these reasons. Most recent notable combinations. So Express Scripts acquired Medco Health Solutions Group. The deal was valued at $34.3 billion. Duke Energy acquired Progress Energy for $32 billion. Google acquired Motorola for $12.4. Microsoft acquired Skype for approximately $8.5. Bristol Myers Squibb acquired Amylin Pharmaceuticals. As you can see, there are plenty of mergers or business combinations that go on here. Facebook acquired Instagram for $1 billion. So how do you recognize this? So recognize when consolidation of financial information into a single set of statements is necessary. There is a presumption that consolidated financial statements are more meaningful and that they are usually necessary for fair value presentation when one of the companies in the group has control. Consolidated financial statements provide more meaningful information than separate, and consolidated financial statements more fairly present the activities of consolidated companies. You have to think to yourself, like, if you control a company, so 50% or more than 50% of the voting common stock, and there are other requirements for control. But if I control the company, then I can manipulate their financials. I can do all kinds of things. So they're not a separate company, really. And so I try to think about those reasons, and that they would really need to be consolidated. Yet consolidated companies may retain their legal entities. So, for example, Pepsi owns Lay's chips, but you don't go and find Pepsi chips. So they potentially can have separate legal entities, yet still be consolidated into one PepsiCo Incorporated. So define the term business combinations and differentiate across various forms. So there's multiple forms of business combinations. A business combination refers to a transaction or other event in which the acquirer obtains control over one or more businesses, is informed by a wide variety of transactions or events with various formats, can differ widely in a legal form, and unites two or more enterprises into a single economic entity that requires consolidated financial statements. For example, Newell Rubbermaid owns American Saw. They purchased American Saw several years ago, which is a local company, but they also own Graco Baby, they own Sharpie, they did this for many reasons, to diversify, to have vertical integration, and so most of the companies that you see on the New York Stock Exchange, those large companies, they've acquired many different companies. So here's different types of combinations. A statutory merger through asset acquisition. So this acquires assets and often liabilities, and the company that was acquired goes out of business. So this is where one legal entity remains. It's called a statutory merger through asset acquisition. Then there's a statutory merger through stock acquisition. So this is when the company acquires all of the stock of the other company, then transfers assets and liabilities to its own books, and dissolves as a separate corporation, often remaining as a division. This happens frequently as well. And there are tax purposes and other reasons that you might choose one of these types of mergers. And then there's a statutory consolidation through capital stock or asset acquisition. So a newly created entity receives the assets or capital from the original companies. So company A and company B get together and they create company C. The original companies may dissolve while remaining as divisions of the newly created company. Acquisition of 50% of the voting, more than 50%. So if you acquire more than 50% of the voting stock, it is recorded as an investment, controls decisions making at the company. They remain a separate legal entity as a legal corporation, although now a subsidiary of the acquiring company. Control through ownership of variable interests. See Chapter 6, Risks and Rewards. So we are not going to cover these in this class, but you establish contractual control over a variable interest entity to engage in a specific activity. They remain in existence as separate legal entities, often a trust or a partnership. So under FASB's control model, they provide guidance on and defines control when accounting for business combinations with this control model. FASB's glossary, in addition to the majority share ownership, further describes control as a direct or indirect ability to determine the direction of management and policies through ownership, contract, or otherwise. FASB also continues its effort to develop a comprehensive guidance for consolidation of all entities, including entities controlled by voting interests. So kind of here's an idea of how it happens. So you take the parent's financial data, you take the subsidiary's financial data, you bring it together, and you report the financial position, results in operations, and cash flows for combined entity. Then there is a reciprocal accounts, and inter-entity transactions are adjusted or eliminated depending on the transaction. And then you prepare a single set of consolidated financial statements. What is to be consolidated? If a dissolution occurs, then all appropriate account balances are physically consolidated into the financial records of the survivor. So basically we move the assets and liabilities over to the company that remains in a one-time situation, and that's it. And that company moves forward. If a separate corporate incorporation is maintained, only the financial information on work papers, and this is what we will make in this, I will do both of these, but this is what we will make in here, not the actual records, is consolidated. Yes, so this is just a consolidated worksheet. When does the consolidation occur? If dissolution occurs, permanent consolidation occurs at the combination date. So if the other company is going to cease to exist, it's a permanent consolidation at the date of combination. If a separate corporation is maintained, the consolidation process is carried out at regular intervals whenever the financial statements are prepared. So that consolidated worksheet that we're going to talk about and do work on, that happens all of the time if separate legal entities are maintained, every time we make financial statements. How does consolidation affect the accounting records? The dissolved company's records are closed out. Surviving companies' accounts are adjusted to include appropriate balances of dissolved company. If a separate corporation is maintained, then each company continues to retain its own records, and worksheets facilitate the periodic consolidation process without disturbing individual accounting systems. Describe the valuation principles of the acquisition method. So the acquisition method embraces fair value of the acquirer's interest in the acquired business. Applying the acquisition method involves recognizing and measuring the consideration transferred for the acquired business and any non-controlling interest. So what are we giving the company? If we were the buying company, what are we giving them? Are we taking a loan? Are we giving stock? Are we paying cash? What are we doing? Assets? And then separate identified assets acquired and liabilities consumed. So in exchange for us giving them cash or some sort of liability or something like that, or stock, then we need to identify each asset and liability that we're acquiring. And goodwill or a gain from a bargain purchase will happen if you pay more or less than book value of those assets. I'm sorry, more than less than fair value of those assets. Fair value is defined as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The market approach estimates fair value using both market transactions involving similar assets or liabilities. The income approach relies on multi-period estimates of future cash flows projected by that generated by an asset. And the cost approach estimates fair values by reference to the current cost of replacing an asset with another comparable asset. What if the consideration transferred does not equal the fair value of the assets acquired? If the consideration is more, then the remaining amount will be contributed to goodwill. If the consideration is less than fair value of all the assets acquired, we got a bargain and we will record a gain on the acquisition. Learning objective 2.5. So determine the total fair value of consideration transferred for an acquisition and allocate the fair value to a specific subsidiary's assets acquired, including goodwill and liabilities assumed, or to gain on a bargain purchase. So, legal and accounting distinctions divide business combinations into two separate categories. Acquisition method when a dissolution takes place, and acquisition method when separate incorporation is maintained. All right. Acquisition method, purchase price equals fair value. A certain BigNet company owns internet communications equipment and other business software applications. It seeks to expand its operations and plans to acquire Smallport on December 31st. Smallport owns similar assets. Smallport's book value is $600,000 and a fair value of $2,550,000. Fair value for assets and liabilities are appraised. Capital stocks, retained earnings, dividend revenue, and expense accounts represent historical measures. The equity and income accounts are not transferred in a combination. So here's how this is going to look. We have BigNet, book values, Smallport, book values, fair values. So prepare the dissolution if consideration transferred equals the net identified assets. So current assets, equipment, capitalized software, and customer contracts. So basically, if a dissolution occurs and you're paying exactly fair value, you write on the assets and liabilities of the other company. And then they paid here by issuing common stock. So that's one of the ways that this is consideration transferred. So they issued $10,000 par value common stock in exchange for this. So in this next one, the difference is that they paid more. So you will see goodwill written onto the books of the company, the acquiring company, if you paid more than fair value. If you paid less than fair value, you won't see goodwill. On the credit side, you will see a gain on a bargain purchase. So you'll have to pay taxes on this gain. Related cost of business combinations. Using the acquisition method, accounting for costs frequently associated. Consideration transfers equals fair value of net identified assets. Identified assets acquired and liabilities assumed and then recorded at their fair value. Now, if it's greater than the identified assets, the net amount will be recorded as goodwill. Direct costs of the acquisition. So, if you have attorneys, appraisers, accountants, investment bankers, they are not part of the fair value received, and they are immediately expensed using the acquisition method. Indirect or internal costs, like management time, are period costs, expensed as they are incurred. And cost to register or issue the security related to the acquisition reduces their fair value. So if there's a cost to the stock issuance, that comes out of the fair value. If it's not dissolved, what do we do? We're going to go over this in Excel and work through a problem after this. Dissolution does not occur. Then the consolidation process is similar to the previous example. The fair value of the basis for initial consolidation of the subsidiary's net assets. Then the subsidiary is a legally incorporated separate entity. Each company maintains independent record keeping, and consolidation of financial information is simulated on a worksheet. Acquiring company does not physically record the transaction. So when you're preparing a consolidated worksheet to account for the for the accounts of two companies that form a business combination if a dissolution does not take place. What are the steps? A consolidated worksheet entries or adjustments and eliminations are entered onto the worksheet only. Steps in the process. 1. Prior to constructing the worksheet, the parent prepares a formal allocation of the acquisition date fair value similar to the equity method procedures. 2. The financial information for the parent and the sub is recorded in the first two columns of the worksheet, with the sub's prior revenue and expenses already closed. Remove the sub's equity account balances. Remove the investment in sub balance. Allocate the sub's fair values, including any excess of cost over book value, to identifiable assets or goodwill. Combine all account balances and extend into consolidated total columns. Subtract the consolidated expense from the revenues to arrive at net income. All right. I think it's much harder to follow this in a work. I'm just going to make sure we're not missing anything important. I am going to talk about describe two criteria for recognizing intangible assets apart from goodwill in a business combination. In determining whether to recognize an intangible asset in a business combination, two specific criteria are essential. Does the intangible asset rise from a contractual or other legal obligations or rights? Is the intangible asset capable of being sold or otherwise separated from the acquired enterprise? Intangible assets lack physical substance, excluding financial instruments. They arise from contractual or other legal rights. Most intangible assets in business combinations meet the contractual legal criterion. Is capable of being sold or otherwise separated. Pre-existing goodwill recorded on the company's account is ignored in the allocation of the purchase price. In-process R&D that has reached technological feasibility is capitalized and is an intangible asset at fair value with an indefinite life and reviewed for impairment. So in-process R&D would go on as an asset and tested for impairment. Ongoing R&D is expensed as incurred. So this gives you a list of intangible assets: marketing related ones, customer related ones, artistic related assets, contractual loyalty, lease agreements, construction permits, technology based ones, patents, computer software, unpatented technology. And this is where we're going to stop, and we're going to do a separate video on an example on how to work through a dissolution where it's dissolved, and then how to prepare a consolidated worksheet.